Hi everyone, this is Raul Harad, CEO of DeepSafe, with another stream. And today I wanted to talk to you guys about something maybe a little bit different, but excuse me, that is very relevant to us, and that is the growth of, or the mainstream acceptance and growth of Bitcoin and Ethereum ETFs. Now, Bitcoin ETFs have been around for a couple of years now. Um, Ethereum ETFs have not yet been approved in the US by the SEC. However, they have made signals that this is going to happen. And it really is transforming crypto from a niche asset into a legitimate investment class for traditional finance. And that makes it relevant to us because that means that there's going to be a lot of movement and a lot of trading, particularly from the institutional side, which up until now has not been able to access Ethereum ETFs or exposure to Ethereum because of their risk management. Now, the current volatility of major coins has been up and down. We have seen that. But there are some important things that I'd like to highlight. In terms of Bitcoin, the US regulator, so the SEC, approved ETFs in 2024. So, yeah, about January of 2024, I believe. So, yeah, almost 2 years. And what this did is it gave investors access to Bitcoin through regulated vehicles instead of buying it directly. And so, following the approval, sizable inflows of funds were recorded. As you can imagine, ETFs tied to Bitcoin absorbed, I believe it was around close to 7%, 6.5% of Bitcoin's total supply by October 2025. So by this year, sorry, by this month, about 6.5% of Bitcoin is tied to ETFs. And so what that did is, when they created the correlation between the S&P 500, NASDAQ, and the different markets, it used to be very different from Bitcoin or any cryptocurrency, but especially, Bitcoin being the driver of most of them. And now what we're seeing is that there is an increasing correlation between Bitcoin and the larger markets, like I mentioned, S&P, NASDAQ. And so basically spot ETFs, are were a big movement within the Bitcoin ecosystem. And they recorded about, it says, $3.24 billion dollars in weekly inflows. And so this makes it the largest inflow of the year. So that's 3.24 billion in a year. And of course, that makes it an inflection point. Now, if we look at Ethereum, in 2025, what we've seen is Ethereum launching or signaling the launch of ETFs with around $10 billion dollars of asset under management. So the utility of Ethereum beyond being a storage of value uh, is being highlighted by institutions, right? So things like staking, DeFi infrastructure, real assets on chain. So the ETF makes it easier for institutional and retail, of course, some retail investors, but institutionals to get exposure to Ethereum. And that means they don't have to give up custody. They can do it securely, they can do it directly, um, and they don't have to worry about, um, having to go through anything that would not be compliant with their risk management procedures. Um, this matters because there is a broader impact that comes from this. So first, we have the legitimization and accessibility, right? So by having ETFs, um, we kind of bridge the gap from crypto as a fringe to crypto as an investable asset class, right? And so for traditional finance institutions, which have mandates, which have restrictions to certain exposures, the ETF wraps kind of this risk and provides them with something that they're familiar with, which is a regulated, broker accessible, transparent financial instrument. Um, so, for example, one of the commentaries that we heard was the approval of spot Bitcoin and Ethereum ETFs provides a regulated and accessible pathway through traditional brokerage accounts addressing custody, security, transparency concerns. So, again, the mere fact that major asset managers are offering these ETFs to institutionals really signals that crypto has crossed the threshold of being considered a serious financial asset. The other thing is that there's increased institutional capital and supply and demand dynamics, right? So, with easier access, as you can imagine, comes more capital. There's a big inflow into ETFs. And of course, that means with higher demand, higher prices, right? So, for Bitcoin, of course, being a deflationary currency, scarcity plays in, right? So, the difference between Bitcoin and Ethereum in that sense is that Ethereum is an inflationary currency. In other words, um, the algorithms can print more Ethereum, can burn Ethereum, etc. Whereas in Bitcoin, there is a limited amount. And so this, of course, plays into, let's say, the aspirational and the um, uh, urgency effect in having Bitcoin. And then, of course, we have portfolio diversification and asset class evolution. So by having ETFs, um, all of a sudden you have alternatives for institutionals, right? So before that, it was too difficult for them to access it because it was too risky. It's operationally heavy, taking all the accounting side of things and putting that in your books and dealing with regulators and so it was a lot. And so um, by making this available through ETFs, by making Bitcoin and Ethereum available through ETFs, all of a sudden we have more access for these institutional investors. And as I mentioned before, we have a product that is structured in a way that they are familiar with and that meets their, let's say, due diligence criteria. Um, and again, as I mentioned, one of the main things is once we have more adoption, we have more credibility. And so, in this sense, we've seen this with Bitcoin in the past. Once we had the ETFs, as I mentioned in January of 24, um, come out into the market for institutional and retail investors, we saw a big, big jump, right? And the credibility went more towards what's the price going to be, and not so much is Bitcoin a real asset. And that's what we're seeing with Ethereum. And of course, with this comes regulatory and market infrastructure improvements. So ETF approval implies that there's a regulatory comfort or at least tolerance with crypto investment vehicles. And so this reduces, as I mentioned, a major barrier. Um, in 2024, it says the year 2024 is a watershed year for digital assets, with the SEC granting approval for spot Bitcoin ETFs. This approval signifies the maturation of Bitcoin as a legitimate investment vehicle, right? So by doing that, we have custody, transparency, auditability, and liquidity concerns that are being addressed through the structure of the ETFs themselves. And so this institutionalization pushes for better standard, for more compliance, for better market practices. So it really benefits the ecosystem overall. Um, Now, there are important caveats to this topic and emerging considerations. The first one is that volatility remains. We have seen a reduction in, let's say, the wild swings, but crypto remains a much more volatile asset than most traditional finance investment vehicles. And so while the ETF reduces some of this friction, the underlying asset is still the underlying asset and it's still volatile. There is a correlation risk. So as crypto becomes more integrated, its diversification benefit might reduce. In other words, as Bitcoin becomes more correlated with larger markets, as I mentioned earlier, it becomes less of a diversification tool because it follows the trajectory of more traditional instruments in the market. And so it makes it a bit less of a hedge or a way to diversify. It makes it a bit more um, tied to what's going on with the larger macroeconomic market environment. The regulatory risk still remains. While we have this approval and it has created a path, we need to see that this continues. We don't know. We've seen sometimes a little bit of U-turns when it comes to policies and regulation. Hopefully, this won't be a, let's say, politicized topic, but rather one that is discussed despite the leadership in terms of the countries that really move the markets. Um, it's also important to consider the changing dynamics of supply and demand. So, as institutionals uh, invest into these ETFs and amass a larger chunk of the market, so as I mentioned, in the case of Bitcoin, about 6.5% of the Bitcoin supply is now in ETFs as of October of this month of this year. And so we need to make sure that we consider that into our analysis, right? So we saw, as I mentioned, $10 billion go into Ethereum ETFs on launch. And of course, that moves the market. Utility versus speculation is another important topic. So questions remain about how much the value is driven by infrastructure utility versus speculation. And so this is something that is important to understand. And then we have fee and structure effects, right? So as ETFs come with management fees, they may not perfectly replicate the coin ownership because they're not just going to have, let's say, the coin's market performance, but that performance will be affected by fees that they have to pay to the brokers that are handling this for them. And of course, that will reduce the ROI. Now, in terms of implications for investors and finance more broadly, for portfolio managers, now you have crypto represents an available asset class. So, depending on the risk tolerance of the different portfolio managers, some may start allocating a small portion of their portfolio to Bitcoin or Ethereum ETFs. And so, this is something to consider if you're a portfolio manager. If you're a retail investor, the availability of ETFs means less friction. So no need for crypto exchanges. You have self-custody wallets. No need for complex security issues. Um, but it is important to understand that the underlying risk remains, right? In terms of the financial broader system, crypto is moving more from the fringes towards a traditional finance tool. And that means there's more connection between crypto and global financial markets. So when we talk about interest rates, when we talk about regulatory shifts, macroeconomic factors, things like tariffs that were obviously a big topic this year, all those things can affect the broader financial system, which of course will have an impact on crypto investments. For price dynamics, we see a more predictable institutional flow, which may change the supply and demand structure of these coins, as I mentioned. And also with greater liquidity means there's fewer flash crashes, but every big institutional move could have a large scale impact on the market. And then finally, for innovation and market structure, as crypto becomes more mainstream, we may see other derivative structured products, index funds, tokenized assets, etc. We might start seeing those um, enter the discussions, let's say, of approval and more traditional finance access, like we've seen with the ETFs. And so that's a topic I wanted to discuss with you guys today. I really appreciate all of you connecting and being around. I hope this was interesting, and I will talk to you all tomorrow. Looking forward to that. Have a